Welcome to the video CPA. Good to be with you again. It's actually July 3rd of 2021, and hope you have a good Independence Day tomorrow. So today we're talking about investment interest expense. This will not apply to all of you, and the reason is that some of you don't have investment interest expense, but the other reason is you've got to be able to itemize your deductions before you can take this expense as a deduction. So it is done on Schedule A. So if you're not filing Schedule A on your tax return, you're not going to get a deduction for this, unfortunately. All right, we have our disclaimer here and our educational disclaimer. And this is what this says. If you're not itemizing, you can't take this deduction. So just be aware of that. All right, so what do we mean by investment interest expense? For those of you that want to prepare income taxes or are preparing income taxes, it's usually expense that you pay or accrue on a loan or margin interest, something that you've invested in that's not a trade or a business, and because of that investment you're incurring expenses, okay, and interest expenses on it. So now there are types of interest expenses that aren't included. We have a list here. Qualified mortgage interest is not included here. It's deductible in a different way. Interest paid on passive activities or on rental property where the taxpayer does not materially participate is another example. Capitalized interest, of course, would not be part of investment interest. Interest expense related to tax-exempt income. If they're not taxing you on the income, they're not going to give you an interest expense, okay? And then interest not expense with respect to life insurance, endowment or annuity contracts issued after June 8th of 1997. So those are some examples of interest expense, investment interest that, expenses that do not fall into investment interest, the definition of investment interest. Let's go a step further and look and see what property held for investment is, okay? And this is going to be a property that produces income, but it's going to be investment property that produces income, so it's not held for trade or business, all right? So an example would be if you've got money in a bank account and it's drawing interest, that would be investment interest. Income, dividend income on stocks. Certainly interest on bonds would be in there. And you'll notice the Alaska permanent fund dividends are not included in this, so they would not be property held for investment. Gains or losses from property sales certainly would, any of that type of property that you're selling would be included in investment income when you sell it. So those would be things like stocks and bonds, cryptocurrency, things like that. Royalty income, annuity income, and it also includes income that is flowing through to you from a partnership or an S corporation on Form K1 or from a estate or a trust on K1. So all of that would be property, would be considered property held for investment. All right, let's look and see how this deduction is calculated. I mentioned before it's done on Schedule A, but even before you get to Schedule A, you've got to net your investment expenses against your investment income. And if you don't have investment income to net it against, well, then it's going to carry over until you do. So it'll carry over to the next tax year until you get some investment income to net your investment interest expense against. If you do have investment income, well, then in many cases you're going to have to complete Form 4952. And I mentioned that it's deducted on Schedule A, but 4952 is a form that then will feed into Schedule A, giving a little bit more information about what you're doing. So 4952 has to be done if you've got carryovers, if you've got more than one type of investment income, Um, Things like that. There are basically three things listed in the directions to Form 4952, and on who has to file the form. If you've got deductible investment income of another kind, you're going to have to do 4952. And if you get qualifying dividends, something like that, you're going to have to do it as well if you make the election. So to include your qualified dividends and capital gains in your calculation of net investment income. So 4952 in most cases will have to be filled out, but in some cases it does not. Let's go ahead and look at 4952. In 4952, you've got your total investment interest expense, which we've talked about. So you list those, and this is paid or accrued, all right, during the tax year. And then if you've got any disallowed interest expense from a previous year, you put that there. You're not going to see that a lot. And then you calculate in part two your investment income, and so you compare the two, and then net them. So fairly easy form to fill out, and then like I say, your investment interest expense deduction in part three is going to be carried over to Schedule A, and that is why you have to itemize your deductions in order to get this this deduction. So anyway, fairly straightforward. It's not so straightforward in calculating, you know, what your investment interest income or your investment income might be at times. But just be aware, if you don't itemize, you don't have to worry about this deduction. You're just not going to get it. So if you've got brokerage accounts and you're paying margin interest on those brokerage accounts, you're not going to be able to get that interest. If you do itemize, though, the interest that you pay on mortgage brokerage accounts or loans would be deductible. So I appreciate you watching a fairly short video, but it is an important video if you've got investment interest expense and you want to deduct it. And sometimes you can't deduct it, but it carries over, and so eventually you will get deducted at sometime in the future, hopefully. So again, if you haven't subscribed, please subscribe. Like this video if you've enjoyed it, and we'll see you again in a week to 2 weeks on another video. Thank you.